This also is the right time to bring on board another great person who I've personally and professionally interacted with him in last 20 years. That's Manish Chokhani. He's back on television after a big hibernation or lockdown, so to speak. Manish, good morning. Thank you for joining us. Hope everything is fine and safe at your end.
And it's good to see all of you chugging away every day, keeping the spirits alive for the country.
I was thinking of how should I frame the question, and when Abha and Aisha and we were discussing that what should be the first question, I said the first question really has to be an expression with my hands out and trying to understand from you that what is happening in the world. Manish, kya ho raha hai?
I wish I knew the answer. You know, the legendary Charlie Munger, he paraphrased something which I think Jack Welch had originally said, that if you're not confused by what's going on, you don't really understand anything. So that's really the kind of the world we are living in, where at least for old timers like me who grew up, learning basic economics, the fact that we draw the law of gravity in financial markets from interest rates and thereby then from currencies. And if interest rates are now being manipulated by, the central banks in the world and kept at artificially low levels, and so also with currencies, and for the first time in my life, I've started seeing, Federal Reserve going and buying even junk bonds. I thought I had seen, the ultimate when Japan and other central banks started buying equities. But this is clearly a new world with, kind of new economics going on. So let's see how this plays out.
So what is going to unfold next now, Manish? Low interest rates are here for a long period of time. Liquidity would be abundant. A new normal has been reboot. Everybody is trying to print money. So how does the rule of investing change in this kind of a market? Because like you said, interest rates, they act like gravity only when they go higher. If the force of gravity is missing and if there is liquidity and yields are low, will the party continue?
Yes, Nikunj, I think that's the bet the world markets are taking right now, that interest rates are low. And therefore, the reciprocal of interest rates are P multiples. And therefore, P multiples can literally go to the sky. And I'm reminded of Japan in 1987 when interest rates were at 0 and 1% there. The P multiples were taken as an assumption that it should be 100. Now, the difference is when interest rates go down because of productivity gains, then you get high P multiples and companies can still make ROEs. But when interest rates are kept low the way they are today, they keep zombie companies alive, they depress profits, and thereby ultimately earnings don't come through. And therefore, my fear is that while we are enjoying this global upsurge in stock valuations, it's possible that we are going to go through a Japanification of the world. And as you know, Japan's stock market didn't cross its peak since 1987. And the economy is basically stagnated, it's gone sideways. And there's been deterioration in standards of living. And I think the developed world is kind of okay to accept it because they've built out the infrastructure. Everyone's got their home and their cars. So even if they stagnate, they're okay. I just wonder about how India is playing this game and why we are allowing our currency to depreciate, why we are taking higher interest rates, why we are unable to get our export engine going despite a 90% devaluation of the rupee in the last 12 years. So those are the kinds of thoughts that I worry about. Having said that, I know you'll ask me at the end of the show, what do? You still end up buying things which are scarce and rare and which will make, profits on a sustainable basis. And I'm sure as we get along, we'll get to that.
Okay. So let's divide the world into two parts, Manish. One, companies, sectors, businesses which have got affected because of COVID, and companies and sectors which have got affected only because of lockdown. So where there is permanent damage and where there is temporary damage. And maybe if we can add another part, that companies and businesses which would benefit because of COVID. Each crisis will give an opportunity and will create a space for better companies to move on. So how would you divide the world into permanent damage, temporary damage, and new opportunity?
So Nikunj, I think of COVID as not as something new. In a sense, the world's been getting continuous series of shocks, whether geopolitical or whether technology disruption or indeed this time on health. What each of these is doing is, in a way, accelerating trends which are already there. It's not something that is going to be completely new. Of course, it will wake up governments like ours in India that we need to have more healthcare. We cannot have 15,000 doctors per Indian citizen. It's also caught us snapping, for example, when China came on the Ladakh border, and we suddenly, after ordering 36 Rafale jets, we now realize we can order 33 more overnight from Russia. But things like that, reactive things will happen. But the underlying trends which were there of demographics and of technology disrupting, I think is only going to accelerate. And the winners, therefore, you are seeing in a way the market's been voting for. In the overseas market, it's very easy to follow that what are referred to as the Fang Mang stocks. As the world gets more and more digitized and software eats more and more of the world, that starts playing out. You've seen that even actually play out in India, where Reliance has virtually doubled between March lows and where we are today. It's been very similar in US, where Amazon alone has gone from, I think, 1900 to 2900. And it's accounted for like a 5% rise in the overall indices, even in the US. So things like that are going to play out on a more accelerated basis. And if you just step back and you think of it, where is big money made in the world historically and kind of even going forward? You always buy low unit value, repetitive purchase consumer products. You always buy the leading technologies which come out and which disrupt things. You always buy the financials. And the fourth big area, which used to be energy, I think is also ripe for disruption. And our very own Reliance here has shown the way that they're preparing for that world where, we go away from a petroleum future to, maybe a more renewable future. And, thereby kind of reinvent yourself. So I think these would be the 4 or 5 big baskets, how things will play out. And we can go deeper into, each one as you choose.
Sure. Manish, morning. I'm going to come to the FANGs and the Indian FANG Reliance in just a bit. But firstly, really setting the context on what India really needs to do. And at a macro level, Manish, you've often highlighted the importance of low cost of capital, about appreciation of the rupee. How critical are they? And more importantly, how easy would they be to implement given the environment that we're in?
So that's a great question. And, again, something we've spoken about that, in a way, post 2008, the world went to a new form of economics, and they are now playing what I call T20 cricket. And India is continuing to play by the rules of the 1960s and 1970s and what I call test match cricket. And we are just continuously focusing only on what they call the inflation differential, and thereby coming up with some notion of a real effective exchange rate. So it's a circular argument that as the rupee falls, we get more inflation. And as we get more inflation, the real effective exchange rate deteriorates and the rupee needs to fall even more. And to prevent that, we keep interest rates up. So the economy slows down and the rupee falls even more. And what the world has been playing since, the last few decades, in my view, and even if you notice, China caught on to this game very early and they pegged their currency to the US dollar. And despite whatever has been said about China getting into debt troubles and so on and so forth, the reality is China has gone from being the same size as India to now becoming 5 times the size. And they've used this low interest rate environment and the fixed exchange rate policy to improve productivity in their country, build out the infrastructure, become the export engine of the world, and now already graduating to what they call a post-export consumption-oriented economy. And I think we've missed the game by allowing the rupee literally to depreciate by 90%. It's destroyed purchasing power locally, prevented our industries from gaining economies of scale and thereby not having the export abilities or productivity. And I'm not saying it's that's the only reason. We do need to fix, of course, a lot of our factors of production, admin reform, judicial reforms, all of that. But that would have made the cry even stronger to say that we are unable to compete. And the second big thing, which I think we need a change in our mindset, is we still operate in what I call a colonial or post-imperialism mindset. We still want to act like the service boys or the coolies of the world, if I may call it that. And think of it, we are discussing a post-industrial revolution kind of IT internet age. And with all due respect, while we have the best IT brains and talent in our country, our IT exports are somewhere in the region of $75 billion, which is like maybe 2.5% of GDP. This in a world where the context is, you've seen the creation of the FANG stocks in the US, you've seen the creation of Baidu, Alibaba, Tencent in China, which are hundreds of billions of dollars. And we've missed a trick by just being their coders and not going up the value chain. Similarly, we cracked the export market for pharmaceuticals, but remained at the low end of the generic game. And all of our pharma chemical exports put together are like $40 billion, which is not even 2% of GDP. When you know the market to which you're exporting, which is the US, has a 15% share of their $22 trillion economy in healthcare. So the size of the miss from India, by just playing at the lowest end of the value chain, which started in the old days of textiles, is just repeating in industry after industry. And that's what is disappointing, that at a policy level, we are unable to crack what we want to do on the rupee, on tariffs, on reforms, on getting into FTAs. And on the industrial side, our industrialists are unable to, because maybe we're not creating enough profit, or maybe it's a mindset issue, to get up the value chain and start playing for a bigger game and a bigger share of the pie globally. And I do think the time is ripe for it, given the geopolitical structure of the world right now, with the world going against China, that if India Inc. and government gets together, we could have a golden period ahead of us. But having said that, I'm realistic. I don't see it happening as yet. Dialogues are on, but let's see where this goes.
Maybe in those 59 banned apps, we could emerge, or rather see some winner come in. But anyway, Manish, we've often talked about as to how profit as a percentage of GDP is at an all-time low. When it comes to India Inc. and tying it with what investors can do right now, I mean, while India prides itself as being a consumption leader, a consumption-based economy, no Indian consumer company has profits of even $1 billion. Where do you think, within the given scenario and within the current umbrella, are there investment opportunities? And more importantly, how can India Inc. really capitalize and build on the profit pool, which again, investors would spot and find opportunities in?
So Aisha, again, great question. And it's something I've cried about for very long, that I've just excluded ITC because in a sense, cigarette profits are super normal and supernatural. But Unilever, Hindustan Lever, although it has a $60+ billion market cap, their profits still after 100 years of being in India are below $1 billion. In a $3 trillion economy, if your largest consumer goods company does not make $1 billion, it says something about what we've done to flatten the kind of economic curve for people in India. And I've often used the metaphor of the three Indias, where 2% of India, the people who own Marutis, who by no means are rich, they could be called Mexicans at best. There are 2% people like that in India, and we've throttled that 2% with high taxes on whether they buy cars or whether on their personal taxes. Then there's the 18% which follows that 2%, which are what we call as people who serve these people and who are on two-wheelers. And then 80% of India is Africa, and they are basically on bicycles or walking bare feet. And unless you allow economic expansion and you allow these 2% to thrive and get this 18% bracket to come into the 2 and the 80 to come into that, the Filipino category from being Africans, this is going to continue. And if you keep on depressing the profits in the country under whatever guise, and I can just refer to, for example, the golden goose of telecom sector, which was destroyed with policy over here. You see what happens, that long term, our top companies are now owned by foreigners. Even Reliance, the mighty Reliance, has to get 25% of its equity now from overseas. Now, we are all celebrating today that 70 billion has come in, and 2.5 lakh crores has come in by way of overseas and Indian rights issues. But all these guys have invested so that they will double or triple their money over the next 3 to 4, 5 years. And in 3 to 4, 5 years, if the money which has come in of 2 lakh crores has to be repatriated out, what does that do to us? Already the HDFCs and the ICICIs and the Infosys and all are owned by foreigners. So we keep having this myopic policy of let's depreciate the rupee to protect the exporters. You're basically exporting the jewels of India outside. And basically, Indians don't have enough wherewithal to reinvest because the profit pool is so shriveled and shrunken over here because you've kept the consumer market so depressed. So I again come back to both things have to happen. That number one, the government policies have to radically change. It's a bit like 1991. And we've been kind of walking in a particular direction and we got to completely change direction there. And number two, for India Inc., there are few people like Reliance who think entire value chain and think capture of that value chain. And again, I'll give you context. If you take the entire Indian tech sector market cap, it's what, about $200 billion or less. And I'm including TCS, Infosys, Wipro, Bharti, everything in that. And over 10 years of dogged effort, Reliance has already reached a $70 billion market cap only on its tech side of its platform. And if these companies, which are, now let's say $270 billion on a, $3 trillion economy and a some 2 trillion market cap, if this size expands, this could potentially make larger and larger profits if they can keep going up the value chain. And that may be where the future of the country lies. The other is our consumer brands. I can just think of few like Bajaj Auto, who made a goal that I want to sell 25% of my branded product outside India. Now, we may like it, we may mock it, we may do whatever, but at least someone made the attempt. When Marico went to Bangladesh, they found a better market there, they could have better prices there. Why are you forcing Indian people to go outside already to conquer global markets when the Indian market is not yet fully served? It's a reflection of the fact that the Indian consumer is just being throttled and not allowed to actually thrive over here. Thereby, you're not creating scale, you're not creating jobs, you're not creating prosperity, and you're just in a vicious cycle of downward loop in the economy. So I'm hopeful that at least the individual entrepreneurs who have always been the strength of the country, they fight their way through this morass, they gain market share, and they become the wealth creators eventually. And I don't think that theme changes in a hurry.
Manish, but in isolation, where is Reliance headed now? It's got a market cap of $150 billion. The gap between Reliance and number 2 TCS is almost 50%. It's got 14% weightage on the Nifty now. And historically, when a company reaches to 14-15% weightage, it tends to peak out. So whatever Reliance has done is exemplary and extraordinary. But for investors, how does one value Reliance now?
I've said this in the past, and I don't want to sound... because I've been real admirer of Reliance and what they've achieved over the last 30 years and how they've changed and moved their profit pool from polyester to petrochemicals to oil to then to telecom, now to the larger technology play, to retail, which is coming forward, and so on. So as they get into more and more categories, they used to be what I used to always say, they're number 1 to 10 in India. And it's a bit like you have Andrew Carnegie, John Rockefeller, and JP Morgan all in the same family or the same company. It's just completely extraordinary. I mean, I cannot have enough complimentary things to say for what they are able to conceive, visualize, and everyone has ideas in India, but execute on this kind of scale and have the guts to play the long game and suffer for 10 years where the stock didn't perform and then come back with such a roar where it's quadrupled literally over the last 2.5 years. So, completely fantastic. I think the company has already announced that they will eventually be doing, splits, and the old oil and petrochemicals business will be separated out, and which is probably half of the current market cap. And it's something to say that a company which 30 years, got built and created 70 billion has already created a $70 billion kind of new age business in there. And even in there, the tech retail consumer platform, if you will, if the smartest investors in the world have come in and put in money, I would assume they are looking at a 20% type IRR going ahead in that business. They're not here to do charity. And the plethora of people who have put in money are probably seeing that there is a lot more leg on that part of the business when it eventually demerges out, while the old business may have already created a lot of its value capture. And then, of course, like they say, what happens on the retail side as the industry consolidates becomes even more interesting. You're having some kind of trouble in the domestic retail players already. You're going to probably see some whiplash against the Chinese retailers who are trying to come in here. So it's pretty much playing out as Amazon versus Jio game in India. And that's a very kind of exciting thing to think about the possibilities from an investor's point of view. So it again stays with the theme. If you think of it, for last 30 years, what has worked in India? People who went against the public sector and gained market share, whether it was in banking, airlines, television, insurance, telecoms, you created disproportionate market cap. Then you went and what could you do against the unorganized sector and try and organize that? And for example, the rise of Titan or Page Industries and all of that kind of plays into that. And now the world moves into what you call platforms. And what can these platforms and the entire ecosystems capture? And when you think of when you use Microsoft or you use Apple, or indeed what the Chinese created with Alibaba and Tencent was creating ecosystems. And if that ecosystem is getting created here, those are the kinds of plays. So those who will gain disproportionate market share in industry after industry, and those who are creating ecosystems, especially tech-enabled ecosystems, will again gain disproportionately. So a bit long answer, but I hope I'm giving you kind of what are the interesting places to look at.
I mean, the kind of insight we were looking forward to. Thank you for starting with Reliance and telling us the importance of platform companies and how globally platform companies are really becoming the modern monopolies. So Manish, you understand the importance of mean reversion, and you've always shared with us that focus on not where the puck has moved, but the puck would move. The face of the Nifty and face of earnings changes every 10 years. Right now, platform, IT, these are great pockets to be in. 10 years ago, it was a combination of infra and perhaps large engineering and other commodity behemoths. 5 years from now, what could be the face of the Nifty? Because if we are able to understand what the Nifty could look like or the Sensex could look like, then we pretty much know that what the outsized pools of profit and capital would be.
So, I have a guru called Mark Faber who I used to follow a lot. And he used to say in stock markets, if you must forecast often because you don't know which one will come right. So at least you can point to something and say it was right. But Nikunj, on a more serious note, the point you're making is right, that the markets tend to have periods of, like you say, seasons, and their life cycles of countries, their life cycles of markets, their life cycles of sectors. And in markets, I would submit that the last 10 years, while a lot of people think was, private sector banks, I would argue actually on a markets perspective, it was really the consumer companies in India, which went completely crazy through the roof on valuations. And in my mind, seeing the reality of how the Indian consumer has not performed for 10 years, the valuation excess in India, in my view, is on the consumer and the consumer discretionary stocks. I mean, we are valuing people making refrigerators and air conditioners and all of that on the same basis as we are valuing, consumer companies like, Lever and Nestle and so on. And also to put in context, it's not like the profit of Nestle or the market cap of Nestle is similar to DMart. And that's the scale of change which has happened in India, that, where the kind of profits seem to be going towards. In the global market, though, you're right that the excessive valuations are occurring in the private equity space and in the technology space. And I, for one, am completely horrified seeing $200 billion valuation for Tesla, $200 billion for Netflix. It's not like Toyota or Disney have vanished. And it's not that they're going to vanish, and you'll see the comeback of these players as well. So there is some pocket of turmoil which is going to occur over there. India is not really a player in that whole FANG-MANG space. And while there will be some level of whiplash back in valuations over there at some point, like you're seeing already with the likes of Facebook, and there was the scare on Tesla and on Netflix from time to time as well. I think that's market giving you a signal of volatility imminent over there. And in India, I would be careful that while the stocks may not collapse, I've lived through a period where Unilever, Hindustan Lever did nothing for 10 years because the stock had run up so excessively in the year 2000. And if indeed this thesis of the way the world plays out, where these low interest rates and the geopolitical breakup of supply chain plays out, the next decade actually goes back to hard assets in a sort of market cycle way. And it could well be commodities are trapped in particular places. And real estate, which we all hate right now, is the most fundamentally hated space in India. That could be interesting kind of asset classes to look at. And hard assets do always at some point make a comeback if inflation comes back, which is the hope for all these macroeconomists in the world.
Okay. Now, Manish, India, in a sense, couple of years has always been a 6 to 7% kind of in GDP growth, plus minus inflation gets adjusted. And that gives a lot of investors like yours to work on the theory
just
of
give me a
earnings
second.
will always revert to the mean.
My father.
That's Manish Chokhani. Well, clearly working.
Yeah. But it's his home.
Okay, so that's work at home. Manish, trust me, we do it all the time. We do it all the time. Sometimes I'm taking a break, sometimes my son walks in, sometimes Aisha's husband is calling him, so don't worry, work at home. This is the new normal you started with. So trust me, for television anchors and for television shows, this is the new normal.
Yes. Sorry, I missed the question while I turned away.
So my question is that let's use the word new normal. Historically, you've always advocated that earnings will revert to the mean. When they go up, they will come down. When they're down, they will come up. But given that India's GDP is contracting, the profit pool is getting haywire, how does one figure out this entire theory of profit to mean reversion? Because that in a sense becomes the next basic benchmark for investors like yours who try to figure out where the earnings will come from.
Yes, that's actually true that right now, I don't think anyone, and I've been seeing interviews of everyone from Suresh Narayan to everyone, nobody has a clue, what is exactly going to happen to demand. Do we come back to, 2020 levels and we recover 100% of GDP? Or do we make a L shape and we become like a, 90% recovery economy? Or do we take longer to recover? Do we have a second wave? So I don't think I have the answers. And normally when you don't have answers, you play with lower valuations. What's perplexing this time is that, as again Mark Faber says, that at the beginning of a bull market, the entrepreneur has the vision and the investors have the money. And at the end of a bull market, the investors have the vision and the entrepreneur has the money. And that seems to be happening now, much as I would like to believe this is the start of a new glorious bull market. The behavior shows that HDFC, Reliance, Kotak, everyone is selling stock. And the investors are buying them, and the investors are seemingly a lot more visionary about where these businesses can go than maybe what the entrepreneur themselves are thinking. And if indeed you do get some kind of shock in the system in the next 12, 18 months, with US elections being imminent, with this geopolitics, with China being imminent, with the COVID situation, we are all kind of hoping the vaccine is out in 6 to 9 months, which will be unprecedented in history. And if it doesn't happen, maybe you get a shock. So if this kind of period of complacency that the Fed has got my back and it will keep pumping money to save the markets is ever punctured at any time in the next 18 months, which will be the time it will take for earnings to recover, we could be in a spot of bother in the market. And I've seen all smart money in the world, Warren Buffett, Jeremy Grantham, Stanley Druckenmiller, they may have been wrong for a long period of time. They're calling it the most gigantic bubble which is being developed in the world. And I remember same way people were mocking them in the year 2000 when the bubble extended for another year and a half. And it's possible this plays out because look, 0% interest money is going to, in theory, it can take your valuations to infinity. But reality also is 0% money means the competitive intensity and the zombie companies stay alive for longer, puts your revival of ROEs and earnings that much at greater risk. So we'll see how it plays out. I'm not finding enough defensiveness in valuations. So while there are companies I love, it's not unusual for me, 3 times in the last 30 years, I've gone on 100% cash. I'm not yet there. And sometimes I would rather sleep well than eat well. And I'm okay to miss some of the rally. I'm okay to kind of look really stupid. I don't answer to anyone anymore. So it's probably better to, at the margin, start creating some buffer because this is not playing out the way I thought it would when the first wave of COVID came. And the Indian response was very good in terms of lockdown, but the way things have played out hasn't been great. And then the way the geopolitical situation has played out and the valuations have gone has not been kind of to my liking at least. So on balance, I'm a more cautious investor today than I would have been, a couple of months ago.
Makes sense. But Manish, how do you hedge yourself then? Do you continue to sit on cash or are there contra opportunities that you try and look at? Manufacturing, for instance, these stocks are undervalued, underowned. People have just about starting talking about this story once this entire shift from China, came into the light.
Yes, Aisha, you're right that you do both, that you try and tilt the portfolio away from where the pockets of excesses are. And you look for what could be deep value. And again, I can play duration because 2 or 3 years, if the stock does nothing, it doesn't matter to me. The second, of course, is you start building some reserves of cash. Third is, of course, Indians have been allowed to also invest overseas. And there are interesting things happening in the world, especially in the FANG space, but in the healthcare, biotech, CRISPR kind of area. A lot of interest. The healthcare stocks actually abroad are very cheap. Pfizer, for example, trades on a 13 multiple. and it may well be the first player out with a vaccine. So people are just not looking at Pfizer, Bristol Myers, Roche, people like that, or indeed Intelia, CRISPR and Editas and so on. So there's interesting things to do outside India, but that's limited. From an India perspective, the value pockets have certainly emerged that people don't look at hard assets anymore, as I was saying. And I remember in the last time we spoke, I said there are 4 pockets one can think of. One is where there are market share gainers because the big are going to become bigger. And while that played out in telecoms, we've seen it playing out also in cement. There's good valuations there. You've seen it playing out in media. You've seen it playing out in, I would believe, in the whole financial space is very, very ripe for that as well. With 4 or 5 banks, will take disproportionate gains in a couple of years from now. The exchanges are going to be listed. The insurance companies are, very interesting. The asset management companies are very interesting. So that's one space where the big are getting bigger, and that becomes like a fulcrum in the core of the portfolio. The second is the area of looking at exporters, because if the Indian market is going to shrink and more stuff is going to be diverted away, hopefully to Indian players. Now, it could be tech, it could be pharma, it could be specialty chemicals, whole host of interesting things to look at on exporters front. So that's a second kind of component in the portfolio. Third is, as I said, on commodities. I personally believe if this world starts creating disruptions in supply chains, some commodity prices will go parabolic. You saw some of it happen, for instance, last year with the graphites. And prices just went crazy because of some shutout in China. Things like that could happen. And they're not being priced in the market across the commodities spectrum. And also some real estate players become interesting. And the last category, and I'm stressing the last, because so far we've always been disappointed, is the government has actually made reform and they've uttered the magic word of privatization. And if you start seeing value capture when some of these companies change hands, the value capture is very dramatic. So I'm keeping something dry to see as those things get imminent. If a BPCL goes into somebody's hands, a Concord goes into somebody's hands, the businesses are intrinsically strong and the valuations could be a multiple of what they are today. So there is enough to do. And, while one gets very kind of spellbound by what is going on in one segment of the market, I think this, flight to quality is a bit too excessive in my view. Because if you just buy the best company in the world, you would just buy Nestle in India and Hindustan Lever in India and sit down and not do anything else. But the stock markets are about pricing rate of change. And the rate of change is what I'm hoping to see in these other categories, away from the kind of erstwhile darlings. I hope that answers your question.
Yep. Hope. That's all that we can. I was just YouTubing, Manish, our earlier interview. It was on March 16th, and it seems like it's been decades. That quote that you shared with me from Lenin, that there are decades where nothing happens, and then there are weeks where decades happen, is so apt for the times that we're in.
Absolutely. I think it's going to happen this time from currency markets and bond markets more than equities. So I watch that very carefully. There is a big change coming.
Okay. Manish, I know you love singing and I know you're a Rafi fan and I know how closely you follow Gulzar's poetry. Just something to describe the current environment that we're in. Just anything, maybe a line or two.
No, you've caught me on the wrong foot there. So let me think. I'll text it. Maybe you can tweet it later. Okay, I remember one.
Okay.
There's a very nice one from Gulzar, which says, Zindagi hai, jo hame sa re ga ma सिखा रही है सा रे ग म और हम उसे सारे गम समझकर जी रहे हैं. So you can think of these COVID times as the best of times or the worst of times.
Okay, on that poetic. Yeah, absolutely. Okay, on that poetic note, Manish, great to speak with you as always and great to get all the insights that you've been thinking about all this while. Good to speak with you.